2 indicators. 1. Clean system. Beginners often add indicators when they're losing. I did the opposite. I deleted almost all of them, keeping only 2. And that's when things started to change. No 12 indicator dashboard, no secret paid tool, no flashing arrows. Just 2 simple, reliable lines that tell me which way to lean and when to get out. In this video, I'm handing you the whole setup, the exact rules I trade by, and worked examples so you can see it in action rather than just take my word for it. Quick honest word before we dive in. This is educational, not financial advice, and trading is not a get-rich-quick button. It took me a long time and a lot of red days to get consistent. But the reason I love this setup is that it's simple enough to actually follow under pressure and simplicity. You can execute beats complexity you freeze on every single time. Stick with me, because near the end, I'll show you the exact trade type that made most of my best days, step by step. Setting up the 2 indicators. 2 minutes. Let's build a chart together so yours matches mine. Open a clean chart and strip everything off it. First indicator. Search for VWAP, the volume-weighted average price. When you add it, it shows up with extra bands and shading that we don't want. So, open its settings, go to the Style tab, and uncheck the upper band, the lower band, and the band fill. Leave just the single VWAP line, and I like to color it yellow so it stands out. 1 clean line. Done. Second indicator. An exponential moving average, an EMA. Add it, go to Inputs, and set the length to 8. Honestly, 8 or 9 barely matters. Pick one and stay consistent. I keep mine blue so I can tell the 2 lines apart at a glance. And that is the entire toolkit. A yellow VWAP and a blue 8 EMA on bear price. No RSI, no MACD, no stochastic soup. The whole edge here comes from understanding these 2 lines deeply, not from stacking 10 shallow ones. VWAP, the rule that keeps you on the right side. So what actually is VWAP? It's the volume-weighted average price in plain English. The average price everyone has paid for this market so far today, weighted by how much traded at each level. It resets each session, so it's a fresh read on where the day's true center of gravity sits. That makes it a magnet and a battle line. Price is constantly pulled back to it, and it's one of the cleanest retest spots you'll find on any chart. Now, the single most important rule in this whole system, and it's beautifully simple. I never go long below VWAP, and I never go short above it. That one rule keeps me on the correct side of the day's order flow. If price is under VWAP, the average buyer today is underwater. That's a seller's environment, so I only look for shorts. If price is above VWAP, buyers are in control, so I only look for longs. Break this rule and you're constantly fighting the crowd. Follow it, and you stop taking trades that point the wrong way. And think about why that works psychologically. VWAP is literally the market's average price for the day, so quietly drives everyone's emotions. When traders who bought higher get dragged back to break even at VWAP, many add or defend. When sellers see price sink back to the average, they lean in. You're not guessing sentiment. You're reading the one line that shows where the average participant stands right now. That's a genuine edge, and it costs nothing but the discipline to respect it. One more read that costs you nothing. The slope of VWAP. A VWAP that's rising through the session tells you buyers are in genuine control, and every dip is likely support. A VWAP that's falling says sellers own the day. And a flat, sideways VWAP with price chopping across it is a warning that there's no clean edge right now. That's a day to trade small or not at all. You don't need to overthink it. Just glance at whether the yellow line is tilting up, down, or going nowhere. The 8 EMA, your data-driven trailing exit. If VWAP tells me which side to trade, the 8 EMA tells me when to get out. And this is where the real money hides. My rule is simple. Once I'm in a winning trade, I hold as long as price keeps closing on the right side of the 8 EMA on the 5-minute. In an uptrend, as long as candles keep closing above it, I stay in and let the runner run. The moment a candle closes back through it, I'm out. It's a trailing stop, but one built on live data, the last 8 periods of real price, not an arbitrary number. This one habit changed my results more than any entry ever did. Most people nail a good entry and then panic sell the first green candle, leaving the bulk of the move on the table. The 8 EMA gives you a rule to stop doing that. You outsource the exit to the trend instead of your nerves. You can also use touches of the 8 EMA as quick scalp entries in a strong trend, but honestly its best job is holding your winners longer. Let the line, not your fear, decide when the trade is over. A word on timeframes, because people always ask. I build a picture on the 5-minute. That's where I judge the 8 EMA trail and most of my VWAP retests. If I want a tighter entry, I'll drop to the 1-minute to time it. But I never let the 1-minute noise talk me out of a clean 5-minute trend. Pick the 5-minute as your home base. Use a lower time frame only to sharpen entries, and let the higher time frame context set the bias. Zoom in for precision. Zoom out for direction, never the reverse. The core setup, the VWAP retest. Here's the bread and butter trade. I mark 2 obvious levels each session, the pre-session high and the pre-session low. Then I let VWAP tell me which retest matters. Say price is trending up above VWAP and above the pre-session high. I'm hunting along on a pullback into VWAP because that's the clean retest with the odds on my side. Price dips back to the yellow line. Buyers step in, and I enter long with a stop just on the other side of VWAP. The mirror image works for shorts. If VWAP is sitting below the pre-session low and price is under VWAP, then the retest I care about is the VWAP retest, not the pre-session low. Price rallies back up to the yellow line. Sellers reject it, and I short with a stop just above VWAP. Notice how VWAP quietly does 2 jobs at once here. It picks my direction, and it gives me the exact level to trade against. That's why I can keep the chart this bare. One line is pulling a lot of weight. The key discipline is patience for the retest. Beginners chase the first move away from VWAP and get shaken out. The retest lets the market come to you at a level you can define risk against. If price never pulls back and just runs, that's fine. You skip it and wait for the next clean setup. There's always another retest. You never have to force a trade in the middle of nowhere, and forcing it is exactly where the account damage happens. A quick clarifier that trips people up. Which retest do you actually trade, the pre-session level or VWAP? Let VWAP decide. Whichever of the two the rule points you toward is the one that matters. If price is above VWAP and above the pre-session high and it pulls back, you want the VWAP retest when VWAP is the level price reaches first and cleanest. The pre-session high is your context and target zone. VWAP is usually your trigger. When in doubt, the yellow line wins because it carries the volume behind it. Quick one before the good stuff. If this is already clearer than the 10 indicator chaos most channels push, a like genuinely helps it reach other traders drowning in complexity. No long pitch, promise. Now let's talk about the setup I get properly excited about. Confluence, where the magic happens. Now, the setup I get genuinely excited about. Confluence. That's when VWAP lines up with a pre-session high or low at the same price. Instead of one reason to take the trade, you've got 2 stacked on top of each other. A VWAP retest and a level retest in the exact same spot. Those are my A+ setups. The ones I size a little more confidently into. Because when 2 independent reasons agree, the reaction tends to be sharper and cleaner. You can stack even more on top when the day allows it. A stock or index that's open strong, ridden VWAP from the open, and stayed glued above the 8 EMA the whole way. On days like that, there's often no reason to sell for hours. VWAP holds as support, the 8 EMA holds as your trail, and you simply let it work. Those are the days that pay for the week. But they only show up if you've been patient enough to skip all the mediocre setups in between. Once the basics click, Here's a small upgrade. Anchored VWAP. Standard VWAP resets with the session, but most platforms let you drop an anchored VWAP from a specific candle, a major swing high, a big news bar, the exact session open you care about. Anchoring it to the moment that actually mattered often gives you a cleaner line for that particular move. Don't reach for this on day one. Master the session VWAP first, but it's a natural next step once the core system feels automatic. Sizing and where the stop actually goes. Let's make the risk concrete, because this is what keeps you in the game. The beauty of a VWAP entry is that it hands you an obvious, logical stop, just on the far side of the yellow line. Long off a VWAP retest, stop goes a touch below VWAP. Short into a VWAP rejection, stop sits a touch above it. If price closes back through the average against you, the reason for the trade is gone, so you should be too. No vague, hopeful stops miles away, the level defines it for you. Now, size from that stop, don't guess. Take your account, decide your risk 1 to 2%, and divide by the distance from entry to that stop to get your position size. A tight VWAP retest often gives a small stop distance, which means you can hold a sensible size while still risking only 1%. And because your target is a trailed EMA move that's often several times your risk, the reward to risk stacks in your favor. Small, defined risk plus a trailed winner is the whole engine of this strategy. A third quick example, GBP USD at the London Open. One more, on forex, because a lot of you trade the pound. Picture the London Open on GBP USD. Price opens, pushes above VWAP, and reclaims the pre-session high. That's above VWAP, above the level longs only, by the rule. Cable pulls back into VWAP, buyers defend it, and a clean candle closes back up. Enter long, stop just under VWAP, and trail the 8 EMA as London trends. Same three ingredients, a completely different market. The system genuinely does not care what the ticker says. Indicators support price action, they don't replace it. One thing I have to stress, these two lines won't magically make you profitable on their own. They're tools that work alongside price action, not instead of it. You still read structure, higher highs and higher lows, clean levels, the overall tone of the session. VWAP and the 8 EMA sharpen those reads and give you rules for direction and exits. But they're a co-pilot, not an autopilot. Anyone selling you an indicator that never loses is selling you a fantasy. And don't underestimate how much the simplicity itself is the edge. A cluttered chart with 10 indicators gives you 10 conflicting opinions and a reason to freeze at the exact moment you need to act. 2 lines give you a clear decision, which side and when to leave. Under real pressure, with real money moving, the trader who can act on a simple, rehearsed plan beats the one drowning in signals every time. Go and backtest this yourself on any chart. You'll see it holds up, and that proof is what lets you pull the trigger with confidence. Applying it to today's markets, July 2026. Let me anchor this to real markets as I record. Gold has been consolidating around the 4,000 mark, a huge round number, acting as the session pivot after a big run and a sharp correction earlier in the year. The Nasdaq 100 has been chopping in a broad band, roughly 28,800 up to 30,600, jittery on rate and geopolitical headlines. Both are liquid, both trend cleanly intraday, and both are exactly the kind of instrument where a yellow VWAP and a blue 8 EMA earn their keep. For a UK audience, you'll trade these as CFDs or spread bets, and VWAP works the same anchored to the session you care about, the London Open or the New York Open. The beauty of this system is that it doesn't care what you trade. Gold, indices, or major forex pairs like GBP USD, the two lines behave the same because they're built from the same universal ingredients: price and volume. Learn it once, apply it everywhere. Worked example 1. A gold VWAP retest. Let me walk one through with clean teaching numbers. Picture a London session where gold opens strong and pushes above the pre-session high near 4,000. Price is above VWAP and above that high, so by our rule, I'm long only, and I'm waiting for the retest, not chasing the first candle. Gold rallies, stalls, then drifts back down toward the yellow VWAP line, sitting around 3,996. That pullback into VWAP is my signal to get ready. Buyers step in right at the yellow line. A 5-minute candle closes back up strongly, and I enter long. My stop goes just under VWAP, around 3,992, if price closes back below the average. The idea is simply wrong, and I'm out small. Then I stop managing and start trailing. As long as candles keep closing above the 8 EMA, I hold. Gold rides the EMA higher through the session, and I don't touch a thing until a 5-minute candle finally closes back under that blue line. That single trade can be most of a good day. Notice what made that trade high quality. Everything agreed. We were above VWAP, so the rule allowed longs. The pre-session high near 4,000 gave a level, and the pullback tapped VWAP for a clean retest that's confluence. The entry was defined, the stop was tiny and logical, and the exit was handed to the 8 EMA rather than my emotions. Same 3 ingredients every time. Right side of VWAP, a clean retest, and the EMA to trail. Simple, repeatable, boring in the best way. Worked. Example 2. A NAS 100 short, now the short side, on the NASDAQ 100 as a CFD. Say it's a weak session. The index opens soft and slides below VWAP, and VWAP itself is sitting below the pre-session low, around 29,000. By our rule, price under VWAP means I'm short only, and because VWAP is under that low, the retest I care about is the VWAP retest, not the low. So I wait for a bounce back up to the yellow line, rather than shorting into the hole. Price rallies into VWAP, sellers reject it with a strong 5-minute close back down, and I short with a stop just above the yellow line. From there it's the same trailing logic, mirrored. As long as candles keep closing below the 8 EMA, I stay short and let it slide toward the range lows. The instrument changed, the direction flipped, but the process is identical. VWAP picks the side and the level. The 8 EMA runs the exit. That's the point. One system, any market, both directions. Mistakes that break the simple system. Let me save you some pain. Mistake 1. Breaking the VWAP rule because the setup looks too good. Longing below VWAP or shorting above it feels clever in the moment and quietly wrecks your win rate. The rule is, the edge respecting it when it's inconvenient is the whole job. If price is on the wrong side of the yellow line for the trade you want, there is no trade. Full stop. Mistake 2. Overriding the 8 EMA exit. You panic sell a winner while it's still riding cleanly above the line, or you stubbornly hold a loser that already closed through it. The whole value of the EMA is that it removes that decision from your emotions, so let it. Mistake 3. Trading the messy middle. When price is chopping around VWAP with no clear side and no retest, that's not a setup, that's noise. Sit out. The best traders skip far more than they take. Mistake 4, and it undoes everything else. No risk management. 2 clean indicators won't save you if you size like a maniac. Keep your risk fixed and small 1 to 2% per trade. Put your stop on the far side of VWAP, where the idea is proven wrong, and never add to a loser to get it back. The setup finds the trade. Your risk rules keep you in the game long enough for the edge to show up. Discipline is the multiplier on everything I've shown you. The real edge, you versus you. Here's the truth nobody selling a course wants to lead with. You can have the best system in the world, and it means nothing without discipline and patience. You can know every rule I've given you and still lose if you can't win the daily battle of you, against the urge to overtrade, to revenge trade, to break your own rules the moment they get uncomfortable. The strategy is maybe 20% of this. The other 80 is whether you can actually follow it when money is on the line. But here's the encouraging part. That inner game is a skill, and skills are built. If you show up every session, follow the rules even when it's boring, journal your trades, and keep the risk small while you learn, consistency comes not overnight, but it comes. I'm not more talented than you. I was just stubborn enough to keep refining a simple process until it worked. If you're willing to put in that patient, unglamorous work, you can absolutely get there too. What makes discipline achievable is a routine, not willpower. Before the session, I mark the pre-session high and low and note which side of VWAP price opens on. During the session, I only take the setup we covered, and I say it out loud. Right side of VWAP, wait for the retest, stop beyond the line, trail the EMA. After the session, I log the trade and one lesson. That loop turns good intentions into an actual process, and a process is what you fall back on when the market gets loud and your emotions get louder. Your drill for this week. Here's how to make this stick, and it's free. Put the yellow VWAP and blue 8 EMA on one market you like, gold, the Nasdaq, or cable, and open the replay or just scroll back over the last couple of weeks of sessions. For each day, mark VWAP's side, find the retest, and see how price reacted. Then check whether trailing the 8 EMA would have held the move. Do that for 10 sessions, and the pattern burns into your eye. You're not looking for perfection. You're building trust in the rules through your own reps. The whole system in a minute. Let's lock it in. 2 indicators, a yellow VWAP and a blue 8 EMA on a bear chart. VWAP is the day's average price, and your direction rule, never long below it, never short above it. The core trade is the VWAP retest in the direction the rule allows, and it's A+ when VWAP lines up with the pre-session high or low. Once you're in, trail with the 8 EMA on the 5-minute and hold until a candle closes back through it. Risk 1 to 2%. Respect the rules. And let discipline do the heavy lifting. Go and do the work I can't do for you. Pull VWAP and the 8 EMA onto your own charts and backtest them across a few sessions until you trust what you're seeing. Simplicity that you understand deeply will always beat complexity you can't execute. If this made the setup, click, subscribe, and turn on the bell next week. I'm breaking down exactly how I manage a live trade from entry to exit in real time. Drop a comment telling me which market you'll test this on first. I read them all. Why knowing more keeps making you less. Right, let me show you something before I explain a single thing. This one go trade banked a clean 3-to-1, and I found it in under 20 minutes on a bear chart running the exact same routine I go through every single morning. No 12 indicators. No 6 screens. No sitting glued to the charts from open to close. And here's the part nobody wants to hear. The reason most traders never get consistent isn't that they know too little. It's that they know too much. Every new indicator, every new strategy, every clever little tweak I bolted on over the years, almost every time, my results got worse, not better. The day it finally clicked was the day I binned about 90% of it and traded one repeatable pattern. The same setup, the same checklist, the same execution every day. It felt almost too simple to work. But stick with me, because by the end of this video, you'll be able to run that exact 5-step checklist yourself. And I'll walk you through the live gold example where every box lit up at once. The promise, what you can actually do after this. So here's the deal for the next 20 minutes. First, I'll show you why piling on knowledge quietly wrecks most accounts. Then I'll give you the whole routine in order. How I map location before I even think about an entry. How I filter the news in 90 seconds. The one signal that tells me a move is exhausted. And the 2 bits of confirmation I wait for before I click. Then the entry mechanics, the maths that lets you win less than half your trades and still come out ahead. And finally, how you grow this from a tiny starting stake without blowing up. Keep an eye out later. I'll freeze on the exact candle that got me into that gold short so you can see precisely what I was looking at in real time. Why more knowledge made me a worse trader. Why more knowledge made me a worse trader. Let's be honest about the trap first, because you're probably standing in it right now. Trading feels like it should be hard. We're wired to believe that a market this big, with this much money sloshing about, must need something complicated to beat. So we go hunting. A new indicator this week, a new candlestick pattern the next, a fresh strategy off someone's channel the week after, and every one of them feels like progress. It isn't. The traders I've watched struggle the longest are almost always the ones with the busiest charts and the fattest notebooks, hopping from setup to setup, convinced the next thing they learn is the missing piece. The missing piece was never another indicator. It was subtraction. The turning point for me was giving up on trying to catch everything the market does and instead choosing one clean, repeatable moneymaker and running it to death. Same location, same trigger, same risk. I stopped caring about the 50 other moves I could have caught, and for the first time, my equity curve stopped looking like a heart rate monitor. Simplicity isn't a compromise here, it's the edge. A rules-based routine kills decision fatigue. It kills the emotional pull to chase, and it kills the self-sabotage that comes from making it up as you go. Step 1. Location before entries. Map the higher time frame. So here's the routine, in order. Every morning I open one chart, and I do the least glamorous thing in trading first. I mark location. Notice I said location, not entry. Most people open the chart already itching to click. I don't touch a 1-minute chart until I know where price is on the bigger picture. For gold xauusd, my main instrument, I start on the 4-hour. I'm looking for the zones price has reacted to before, where sellers stepped in and knocked it back, where buyers absorbed the drop and lifted it. Those repeated reactions are your resistance and support zones. And note, the word zones, not lines. The market doesn't respect a single thin line. It respects an area. Now here's why this matters more than usual right now, and it's a live example you can pull up yourself. Gold went absolutely vertical into late January 2026 and printed an all-time high up around the $5,600 region on the 29th. Then it did what parabolic moves always eventually do. It snapped back hard, shed a big chunk of that rally, and by early July it's been grinding sideways, roughly in the 4,000 to 4,200 area. That context is your bias. When a market is chopping sideways in a range, the highest probability assumption is that it keeps doing that until proven otherwise. So as price pushes up into the top of that range, into resistance, I'm leaning toward a fade, a reversal, not a breakout. I treat the market as most likely to carry on doing what it's been doing, and I put the odds at roughly 80% that the current behavior continues. That single assumption stops you fighting the chart. Practically, I draw a small handful of things and no more. The obvious high of the range and the obvious low. The overnight high and low, because London and New York love to hunt those. And if there is a clean sloping line the swings keep respecting, I'll add a trend line, an upper resistance trend line on a rising wedge, say. That's it, 4 or 5 marks. This map does one job. It tells me where to expect a reaction. So when price sprints into that zone, I'm not surprised I'm ready. If you draw 20 levels, none of them mean anything. Draw the few that price has actually paid for. Step 2. The 90-second news filter. Before I look for a single entry, I check the calendar, and it takes about 90 seconds. I use a free economic calendar, filter it to the currency I care about, And I'm only asking one question. Is there high-impact news due today that can move gold? And when? That's it. In this market, that means the big US data jobs, inflation, anything Fed-related, plus anything the central bank chair says on the wires, and the geopolitics that have been jerking gold around for months. Take last week as the perfect example. US jobs came in soft. Markets slashed their bets on the next rate move, and gold ripped over 2% in a session. If you're short into a number like that without knowing it's coming, you're not trading, you're gambling. Knowing the schedule doesn't mean you trade the news. It means you're never ambushed by it. Step 3. The exhaustion signal, the unhealthy move. Now the fun part. Price has run into one of my zones great, but a level touching isn't a reason to trade. Strong trends smash through levels all the time. So I wait for the market to tell me the move is running out of fuel. And I have one simple tell for that. An exhaustion move, or what I call an unhealthy move. Picture it. Instead of climbing in orderly steps, price suddenly lurches one big, greedy candle, far bigger than everything around it. That imbalance leaves a gap, a pocket where price moved so fast it skipped over fair value. On a chart, it shows up as a fair value gap. And the thing about a move that violent is that it's usually unsustainable. The market tends to come back and hand most of that candle straight back. This is my catalyst. When price pokes into resistance and does it with one of these ugly, overextended shoves, I get very interested because it flags a clean snapback. One honest warning. Though an exhaustion move on its own does not mean the trend is dead. Plenty of times price fills the gap, catches its breath, and carries on trending. I'm not betting the whole trend flips. I'm betting there's a high-quality reversal to trade, and I only take it when the next piece lines up. And a quiet note that'll save you money. These setups tend to pay faster on the short side because gold sheds altitude far quicker than it gains it. Fear moves faster than greed. When it goes, it goes. Step 4. Confirmation. The structure shift plus failed retest. Here's where most people jump the gun and where I used to hand my money away. When I want a reversal, I'm effectively calling the end of an uptrend and the start of a downtrend, and that is genuinely hard, so I refuse to guess it. I wait for the market to prove it to me. And the proof is written in the structure. An uptrend is just higher highs and higher lows, stacked. The moment that changes the first lower low, then a lower high, the character of the market has shifted. That's my third box, but I still don't click. I want one more thing. I want price to try to continue up and fail. That failed continuation is the whole game. After structure breaks, the market will usually throw one more push higher. It traps the last buyers who think the uptrend's still on. If that push stalls and gets slammed back down by a big rejection candle, that's my green light. Think about what just happened. Buyers tried, buyers failed, and they're now trapped above me. That's exactly who fuels the move down as they bail. So my fourth box is a failed retest right under a lower high, capped by an obvious rejection candle. When I've got the zone, the exhaustion, the structure shift, and a failed retest 4 boxes, I'm finally allowed to think about an entry. If any box is missing, I don't trade. And if the whole day never lines up, I close the laptop and go and live my life. No setup, no trade. That discipline is the strategy. Quick one if this is landing. Quick pause if the checklist is starting to click. Do me a favor and tap the like button. It genuinely helps the channel put these breakdowns in front of more traders who are drowning in indicators. Right, back to it. Because now we get to the click and the maths that makes the whole thing work even when you're wrong more than half the time. Step 5. The entry. and the maths that carries you. Let's talk about the actual click, because how you enter matters. I don't sit there with a market order twitching to buy the exact tick. Once I've got my failed retest, I place a sell stop order a touch below that rejection low. A stop order does something a limit order can't here. It only triggers if price actually trades through my level and confirms the breakdown. If price never breaks, I never get filled, and I've risked nothing. If it breaks, I'm in the moment. Momentum agrees with me. On that gold example, price rejected the lower high, rode over, and my order triggered as it sliced back below the minor support, underneath, right as the door opened into that empty pocket, the exhaustion move left behind. Those pockets fill fast because there's very little volume in the way. Now the maths, because this is what lets ordinary people trade for a living. I only take reversals that offer at least 1 to 2, and I love a clean 1 to 3. Risk 1 unit to make 3. Why does that matter so much? Because it means your win rate can be genuinely mediocre and you still make money. At 1 to 3, you only need to be right about 3 times in 10 to break even. Everything above that is profit. Flip it around. If you trade a lousy reward to risk, say risking 100 to make 50, every single loss now costs you 2 wins to repair, and that is brutal on your head as much as your account. I've lived on the wrong side of that maths, and I'm never going back. Put the numbers in your favor and let a 30 to 40% win rate quietly grow the account. Managing the trade without giving it all back. Getting in is half the job. Not giving the profit back is the other half. My stop goes just above that failed retest, the level that would prove me wrong. And my first target is roughly 2 times that risk, usually the range low or the overnight low sitting underneath. If I'm honest, this is where beginners should keep it boring. Set a fixed target at 2 or 3 times your risk and let it hit. Managing a fast trade live, by feel, is a skill that takes time. Don't start there. On the gold short, my first soft target was the prior lows. The moment price got moving, I trailed my stop down behind each closing candle, because on a clean break, every 1-minute candle can be worth a chunk, and I refuse to watch a 3-hour winner turn into break even. There's a subtle shift here that matters more than any rule. Don't only think about your reward to risk. Think about where you are in the move. As price drove into the more major support and the fall itself started to look overextended to the downside, I tightened right up. Because the same exhaustion logic that got me in short now warned me a bounce could be coming the other way. Around 3R, I'll happily bank a chunk. If it's still printing lower candles with force, I'll let a runner breathe. 2 questions run the whole exit. Is the reward still worth the risk from here? And has this move started to look exhausted itself? When the answer flips, I'm out. No hero trades. Scaling from a tiny stake the same way. Let's talk about growing this. Because the honest version is less sexy than the adverts, and far more likely to keep you in the game. You do not need a big account to trade this. Start on a demo always when you're learning a platform or a new setup, and prove to yourself you can run the checklist for a few weeks without deviating. Only when the routine is boring and repeatable do you go live, and you go live small. The number that matters isn't your position size, it's your risk per trade. Keep it to 1 to 2% of the account, full stop. That single rule is what lets you survive a losing streak, and you will have losing streaks even with a good system. Scaling then becomes almost boring, which is the point. As the account grows and your execution stays clean, you increase your position size in small, deliberate steps, not because you're feeling brave, but because 1 to 2% of a bigger balance is simply a larger number. The setup never changes. The checklist never changes. The routine still takes 45 to 60 minutes around the session that suits your time zone for a UK trader. That's the London Open and the New York overlap, which is where gold does most of its damage anyway. You can run this alongside a full-time job. What grows is the account, not the complexity. Please hear this clearly though. This is a skill you build, not a lottery ticket. There's no guaranteed number. Results vary, and anyone promising you certainty is selling you something. The exact numbers on that gold short. Let me put real numbers on that gold trade, so it isn't just theory. Price pushed up into my resistance zone in the upper half of the range, through the exhaustion candle, then broke structure with a lower low and gave me a failed retest right under the lower high. I placed a sell stop a few pips below the rejection low. Entry filled around the break. My stop went just above the retest high. Call it a 30 pip risk on the setup. First target was the range low, sitting roughly 60 pips below, so 2R. And the runner went for the overnight low beyond that, which is where the 3R came from. Same maths. Whatever the account size. If I'm risking 1%, that trade returns 3%. If the stop had hit, I'd have lost one and moved on. No drama, no revenge. Next setup. Same checklist, different pair, GBP USD. And to prove this isn't a gold-only trick, run the identical checklist on GBP USD around the London Open, perfect for a UK trader. Because that's when cable actually moves. Say sterling rallies into an obvious overnight high that also lines up with a session resistance zone. Box 1, location, tick. It gets there with one greedy candle that gaps away from the pack box 2, exhaustion, tick. Then it prints a lower low, rolls a lower high, and the pushback up fails on a fat rejection candle boxes 3 and 4, tick, tick. Sell stop below the rejection, stop above it, target the prior session low for 2R. Nothing about the process changes. The pair changes, the levels change, the time of day changes, the 5 boxes do not. That's the whole point of a repeatable system. You carry it, not 100 separate setups. The 2 mistakes that quietly kill this system. Even with a clean checklist, 2 habits will bleed you, and I've done both. The first is overtrading, forcing a setup on a day that never offered one. Your brain hates a blank day. It whispers that surely there's money out there you're missing. There is, and it's not yours to take. If the 4 boxes aren't there, sitting on your hands is the trade. The second is meddling with your stop in the wrong direction, nudging it wider because you feel the reversal is still coming. The instant you widen a stop to avoid being wrong, you've abandoned the plan and turned a defined risk trade into an open-ended one. Move stops to protect profit, never to postpone a loss. Practice this week the 3-0 setup drill. Here's a drill you can actually do this week, and it's the fastest way I know to trust a system. Open the gold or cable chart, scroll back, and hand count 30 examples of the full 4-box sequence: a zone, an exhaustion candle, a structure shift, a failed retest. Mark where you'd have entered, where the stop sits, and where 2R and 3R land. Don't trade a penny yet, just log the outcome of all 30. What you're doing is proving to your own eyes that a 30 to 40% hit rate with these payoffs comes out ahead, so that when you're live and you take 3 losers in a row, you don't panic and rebuild the whole strategy. Conviction doesn't come from a guru telling you it works. It comes from you watching it work 30 times with your own hand. One last habit that ties it all together. Keep a 1-line journal. After every trade, win, lose, or the days you correctly sat out, write a single sentence. Did all 4 boxes show up? Yes or no? Did I follow my exit plan? Yes or no? That's it. Within a month, you'll spot your real leak. And I promise you, it won't be your entries. It'll be the days you forced a trade that wasn't there, or the stop you widened when you should have taken the loss. You can't fix what you don't measure, and one honest line a day measures the only thing that matters. Did I run my own process, or did I improvise? Trade the process, log the process, protect the process. Everything else is noise. The 5 boxes, one more time. So let's lock it in. 1. Location before entries map the few zones price has actually paid for on the higher time frame, and let the range give you your bias. 2. The 90-second news check, so you're never ambushed. 3. Wait for an exhaustion move into your zone, that overextended candle that leaves a gap. 4. Demand a structure shift and a failed retest before you even think about clicking. 5. Enter on a stop order. Risk 1 to make 2 or 3. Protect the profit and size at 1 to 2%. Miss a box, skip the trade. That's the entire edge, not more knowledge. Just the discipline to do the same simple thing, well, every day before you go. If you got value from this, subscribe and turn on the bell. The next breakdown drops every week, and I'll be taking one clean setup at a time and pulling it apart the same way. Drop a comment with the pair you want me to map next. Gold's my home turf, but I'm happy to run the exact checklist on GBP/USD or the indices too. Go and mark your zones tonight. Run the checklist on demo tomorrow, and let the boring, repeatable version of trading do its quiet work. And the important bit, none of this is financial advice. Trading carries real risk. You can lose money, so manage your risk at 1 to 2% per trade, and never risk what you can't afford to lose. See you in the next one. The one thing keeping you broke on gold. What if every time you got stopped out on gold, the move went exactly your way 10 minutes later? You were not wrong about the direction. You were wrong about the entry. And that single mistake is costing traders hundreds, sometimes thousands of pounds a week. I am going to show you the only supply and demand framework you will ever need to trade XAUUSD. No indicators cluttering your screen, no guessing. Just a raw logic that the smart money uses to move gold, and how you can position yourself right alongside them. What you will be able to do after this video. Here is the roadmap for today. By the end of this breakdown, you will be able to do 3 things. First, you will know exactly how to spot a high probability supply or demand zone on gold, not a line, a zone before price even arrives. Second, you will have a 2-step confluence checklist that keeps you out of the bad setups and gets you into the clean ones. Third, I will walk you through a live example in each of the 4 market conditions, ranging uptrend, downtrend, and reversal, so you can use this no matter what gold is doing. Stick around, because later I will show you the exact entry trigger that separates a professional sniper entry from a reckless punt. Do not skip that part. Section 1. Why supply and demand, not support and resistance. Most traders draw a horizontal line and call it support or resistance. The market does not respect a line. It respects a zone, a price area, where institutional orders are queued and waiting. Think of it this way. A big bank wants to sell 50,000 ounces of gold. They cannot dump that in one click. It would move the market against them. So they sell in layers across a price band. That band is your supply zone. When price returns to that band, the remaining orders fire, and you get another leg down. This is why supply and demand zones have predictive power that a single line never will. You're not drawing a line where price bounced before. You are marking where institutional order flow is still sitting, unexecuted, waiting for price to return. From this point on, think in zones, not lines. A zone has a top edge and a bottom edge, typically formed by the body of the candle that started the aggressive move. Section 2. How to draw a supply or demand zone in 30 seconds. Drawing a zone is simple once you know what you are looking for. Here is the exact process. For a supply zone, scan the chart for an area where multiple red candles printed in a row 3 or more with large bodies and very little wicking. That cluster of aggressive selling tells you there is institutional supply at that price band. Draw a rectangle from the top of the last candle body before the drop to the bottom of the same candle. That is your zone. For a demand zone, flip it. Find where multiple large green candles printed consecutively. Draw your box from the bottom of the last candle body before the impulse to the top of that candle. The most powerful zones are the ones where price left quickly and violently. A slow grind up to a level is noise. A sharp, explosive move away from a level that is institutional fingerprints. Those are the zones worth trading. One more rule. The more times price revisits a zone without breaking through it, the weaker it becomes. Fresh zones once price has not yet returned to carry the highest probability. Always prefer the fresh zone over the tested one. Section 3. The two confluence entry checklist. Never skip this. Here is where most traders fail. They see price touch a supply or demand zone, and they fire a trade immediately. Sometimes it works. Most of the time, price just keeps running through the zone, and they take a full stop loss. The fix is a two-part confluence checklist. Both boxes must tick before you enter. Not one, both. Confluence number 1. The 8-period exponential moving average crossover. On the 1 5-minute chart, I want to see the candles cross and close on the other side of the 8 EMA. For a supply zone sell, I need to see candles start closing below the EMA, not just wicking below it, closing below it. For a demand zone buy, candles crossing and closing above the EMA. The crossover tells you the short-term momentum has shifted against a prevailing move. That is your first green light. Confluence number 2, a confirmation candle. I want to see at least one large candle, a bearish engulfing, a pin bar rejection, or a strong-bodied candle in the direction of the trade, forming while price is inside the zone. This candle tells you the institutions are actively defending that zone right now. Not yesterday, right now. When you have both EMA crossover plus confirmation candle, that is when you execute, not before. This discipline alone will cut your losing trades by more than half. Section 4. Trading gold in a ranging market. Most people get this wrong. The ranging market is actually where supply and demand shines most. Most traders see a sideways chart and walk away because they were taught you cannot trade ranges. That is backwards. A range gives you two defined zones, supply at the top, demand at the bottom, and price will oscillate between them until one side breaks. That means you get multiple high probability setups per range, not zero. Here is a real example on xauusd at the H1 timeframe. Price is oscillating between roughly 2,310 and 2,355. At the top of the range, we have a supply zone. Multiple large red candles formed there. Price dropped sharply on each test. At the bottom, we have a demand zone. Multiple large green candles, price bounced hard each time. The setup. Price rallies back up into the supply zone around 2,346 to 2,354. I move down to the 1 5-minute chart and wait. Within a few candles, I see the 8 EMA cross. The candles start closing below the EMA for the first time since price entered the zone. And then, I get a large bearish engulfing candle. Clean, no wick confusion. That is my entry. Sell at the close of that candle. Stop loss above the supply zone top, around 2,358. Take profit at the demand zone below, around 2,315. That is a risk to reward of approximately 1 to 3, 5 on a ranging market trade. No trend needed. Section 5. Trading gold in an uptrend. Ride the pullback like a pro. When gold is in a confirmed uptrend, higher highs, higher lows on the H1, you are looking for demand zones to enter long on the pullbacks. You are buying the dip into institutional demand, not chasing the top. Here is how to identify the uptrend's demand zones. After a strong bullish impulse, multiple large green candles printing in a row mark the base of that impulse. That base is where the institutional buy orders originally fired. When price pulls back to retest that base, there are unfilled buy orders waiting there, and the institutions will add more. Recent xauusd action gives us a clean example. After gold broke above 2,330 inches early June 2025, it impulsed up to around 2,360 on multiple large green H1 candles. The demand zone sits between approximately 2,328 and 2,336, the base of that push. Price pulled back into that zone over the following 2 sessions. On the 5-minute chart, I waited. The 8 EMA had been above price bearish short-term momentum. Then, a large bullish engulfing formed right inside the zone, and the candles crossed above the EMA. That is the entry. Buy at close. Stop below the zone around 2,321. Take profit at the prior high around 2,362. A clean 1 to 4, 5 risk to reward trade, and price ran straight to the target within 36 hours. The key discipline here is patience. Chasing the impulse candle is the amateur move. The professional waits for the pullback to the zone, gets the 2 confluences, and enters with a sniper's precision. Quick one, if this breakdown is making sense. A like genuinely helps the channel reach more traders who need this. It takes 1 second and it means a lot. Right, back to the setups. Section 6. Trading gold in a downtrend. Short the rip. A downtrend is the mirror of what we just covered. Price is making lower highs and lower lows, and you are looking for supply zones to enter short on the rallies, the dead cat bounces that pull price back up before it continues lower. In a downtrend, every supply zone has already proven itself. The first test created the lower high. A second visit creates another lower high and gives you the entry. The structure is already on your side. Here is the setup. Gold has been in a downtrend on the H1. Price has been making lower highs around the 2,358 to 2,366 region. Each time price gets up there, aggressive selling takes over. That is a well-established supply zone with multiple confirmations, which makes it high probability. Price rallies up into the zone again. On the 5-minute time frame, I'm watching the 8 EMA. The candles are above the EMA during the rally upward short-term momentum. Then the momentum shifts. The candles cross below the EMA, and I get a large bearish pin bar rejecting off the top of the zone. That is the entry. Sell at close of the pin bar. Stop goes above the supply zone, above the last lower high, not tight, because price needs room. If you put the stop too tight, a 3 or 4 pip wick will take you out before price collapses in your direction. Give it breathing room. Take profit at the next significant support structure below, around 2,318. The trade played out over roughly 2 days, delivering just over 40 pips and at 0.1 lots on gold. That is around $400 from a single trade. Section 7. Trading a reversal on gold, spotting the shift before it happens. The reversal setup is the one that pays the most, and the one that kills the most accounts when traded wrong. The mistake traders make is this. They see price pull away from a level sharply, and they immediately enter, assuming the reversal is already in motion. It is not. The market must retest the zone to confirm it. Entering before the retest is pure hope, not analysis. Here is how a proper reversal trade looks on gold. Price has been in an uptrend, making higher highs and higher lows. But then, we see a significant red candle push down and take out the previous higher low. That is a warning sign. Market structure may be shifting. We now have a demand zone at that previous higher low area. Price has bounced hard from there before multiple large green candles confirm demand. The question is, will price come back and use that zone as a springboard for another leg up? Or has something fundamentally changed and will it break through? We do not predict, we react. Price comes back down to the zone. On the 5-minute chart, I wait for my 2 confluences EMA crossover to the upside and a large bullish confirmation candle. When both appear, I enter long. Stop below the zone base. Take profit at the previous high or a 1 to 2, 5 risk to reward level. If price breaks through the demand zone instead, no problem. We had our confirmation criteria. We did not enter. We simply re-evaluate the next zone lower. This is how professionals stay in the game long term. By refusing to enter without confirmation, and by never marrying a directional bias. Section 8. Where to put your stop loss. Most traders place it too tight. The most common reason a technically correct setup still results in a loss is the stop placement. Traders put the stop 1 or 2 pips above the zone edge. Price wicks just past it, then reverses exactly as expected, and they are already out, watching the move without them. Here is the rule. Your stop loss goes above the zone, plus a buffer. For gold, specifically, which is a volatile instrument, I use a minimum buffer of 8 to 12 pips beyond the zone edge. On higher timeframe setups, that buffer can go up to 15 or 20 pips. The reason? Market makers know where the obvious stops are. They will often push price a few pips past a visible level to collect those stops before reversing. Your buffer is protection against that. For take profit, the rule is simpler. Look left. Find the nearest significant price level where price previously reversed a prior high for sells, a prior low for buys. That is where price is likely to slow or stall. Place or take profit just in front of that level, not at it, because price may not quite reach it before reversing. Never move your stop loss further away once you are in the trade. If your analysis was wrong, accept the small loss and move on. The professionals that last in this game are the ones who accept small losses quickly and let winning trades run. Section 9. The multi-timeframe approach. H1 zone, 15M entry. Here is a detail I want to make very clear because it is the source of a lot of confusion for newer traders. When I talk about identifying supply and demand zones, I am doing that on the H1 chart, the 1-hour time frame. But when I am looking for my entry trigger, the EMA crossover and the confirmation candle, I drop down to the 1-5-minute chart. Why does this matter? Because the H1 chart defines the zone, the area of institutional interest. The 1-5-minute chart tells you the precise moment within that zone when the institutional selling or buying is actively resuming. If you try to take your entry on the H1, you will always be late. The candle has already moved too far from the zone edge. Your stop has to be wider, and your risk to reward shrinks. The 1-5-minute entry inside an H1 zone gives you what traders call a sniper entry. You are entering precisely when the move is beginning, with a tight stop that still respects the zone, and a target that gives you a favorable risk to reward. Here is the workflow. Step 1. Mark your zone on H1. Step 2. Set an alert so you are notified when price enters the zone. You do not need to stare at the screen. Step 3. When the alert fires, open the 1-5-minute chart and start monitoring for your 2 confluences. Step 4. When both confluences confirm, execute the trade. Step 5. Set your stop and take profit orders immediately and walk away. Do not sit and watch the trade that leads to emotional interference and premature exits. This top-down approach using the higher time frame for context and the lower time frame for execution is the single biggest upgrade most retail traders can make to their process. It keeps you aligned with the big picture while giving you a precision entry that maximizes your reward for every pound of risk you take. Section 10. Risk Management. Why 1-2% per trade keeps you in the game. No strategy, not this one, not any other, will win every trade. Even the cleanest supply and demand setup will sometimes fail. A news event, a surprise central bank announcement, a geopolitical shock can override any technical framework. This is the reality of trading gold, which is one of the most news-sensitive instruments in the market. This is why risk management is not optional. It is the foundation everything else sits on. The rule is simple and non-negotiable. Risk no more than 1-2% of your trading account on any single trade. If you have a £5,000 account, your maximum risk per trade is £50 to £100. If you lose 10 trades in a row, which is genuinely possible even with a strong strategy, you have lost between 10 and 20% of your account. And you are still very much in the game. Now compare that to a trader who risks 10% per trade. 10 consecutive losers gone, account wiped. And 10 consecutive losers is not even that unusual during a difficult market phase. Here is how to calculate your lot size for each trade. Take your account balance, multiply by your risk percentage to get the pound or dollar amount at risk. Then divide that by the number of pips to your stop loss, adjusted for the lot size value on gold. On xauusd, one standard lot moves $10 per pip. One mini lot, 0.1, moves $1 per pip. One micro lot, 0.01, moves 10 cents per pip. So if your stop is 30 pips and you're risking 100 pounds at an exchange rate close to 1, you need a position size that loses 100 pounds over 30 pips, that is approximately 0.33 lots on gold. Most platforms will calculate this for you automatically if you input your risk amount and stop level size correctly every single time. Inconsistent sizing is the silent account killer. Traders double their size on a trade they feel confident about. It loses, and suddenly one loss wipes out 6 previous winners. Section 11. The 5 mistakes that make this strategy fail for most traders. I want to address the most common objections and mistakes I see when traders first apply supply and demand to gold, because I guarantee you will encounter every single one of these. Mistake 1. Entering before the two confluences. I have said this multiple times, and I will say it again, because traders still do it. They see price touch the zone, and they feel the urgency to be in the trade. Resist it. The urgency you feel is FOMO, fear of missing out, and it is the most expensive emotion in trading. If you miss a setup because you waited for confirmation, another one will come. If you blow your account by entering without confirmation, you will not be around to trade the next one. Mistake 2. Trading against the higher timeframe trend. Supply and demand zones work in every market condition, but they work best when they align with a higher timeframe trend direction. If the daily chart on gold is in a strong uptrend, your demand zone buys on the H1 will have much higher probability than your supply zone sells. Counter-trend trades work, but carry higher risk. When you are learning, stick to trend-aligned trades. Mistake 3. Ignoring upcoming high-impact news. Gold is extraordinarily sensitive to U.S. economic data, non-farm payrolls, CPI inflation, Federal Reserve rate decisions, and FOMC minutes. If a major news event is scheduled within 2 hours of your intended entry, wait. The news can create a false break of your zone that stops you out before reversing. Check the economic calendar every session before you plot your setups. Mistake 4. Redrawing zones to suit the trade you want to make. If price breaks through your zone, the zone is invalidated. Do not redraw it lower to justify staying in a trade. Accept the stop loss, move on, and find the next valid zone. Mistake 5. Taking profit too early. Once the trade is running in your direction, the temptation is to close early and lock in a small gain. That might feel safe, but over hundreds of trades, it massively reduces your overall profitability. Trust the analysis, trust the take profit level you identified, and let the trade run. You can always move your stop to break even once price has moved a meaningful distance in your direction, but do not close the trade manually just because of short-term volatility. The 5 things to remember. Let me bring it all together quickly. 1. Trade zones, not lines. A zone has a top and a bottom edge and reflects where institutional orders are clustered. 2. The strongest zones are the fresh ones, areas price left explosively and has not yet returned to. 3. Never enter the moment price touches a zone. Wait for both confluences EMA crossover on the 1 5-minute chart and a confirmation candle. 4. Your stop loss goes beyond the zone with a buffer of at least 8 to 12 pips on gold. Tight stops on gold get hunted. 5. Look left for your take profit. Place it just in front of the nearest prior reversal level, and do not adjust your stop away from you once you are in the trade. This framework works in every market condition, ranging Uptrend, downtrend, reversal. That is the beauty of it. You do not need to predict what the market is about to do. You just need to be ready when price visits your